Good day, guys. I hope you're good. Welcome back to the Candlestick Trading Bible. We continuing from page 100. So before we continue, as promised, we're going to look at the Fibonacci. So the Fibonacci 2 is not something which I really use personally, but for the sake of those who might want to use it, what I'm going to do is I'm going to try to show you how to like configure it on your MT4. I hope my screen share will be able to show it. But anyways, on your chart, if you're a newbie on your chart, you can see we've got your time frames here, your crosshair, your arrows, vertical line, horizontal line, trend line, and this one with the F, that's your Fibonacci. So that's the indicator which you want to pull out. So what I'll do is you click it. Then once you click it, you draw it onto your chart like that. Then you're going to left click, double left click, then you right click, then it should show you properties. Right, when you go to properties, I'm not sure if you can see the properties now, but what I'll try to do is, okay, let me try to share this whole screen so that you can see. Okay, just give me a moment. Let me just do something quickly. Okay, I don't think it will be able to do what I want to do. But anyways, for the settings, if it's not showing, you can just get in touch with us. We'll give you the correct settings. Okay, so I'll just put the levels here. So there's a few levels we want to use, and there's a few levels which we don't need at all. So the first level we need is the 0.382, which is the 38.2. Okay, the 26, we don't need that one. Okay, we're going to delete. Okay, 0.5. Okay, let's see. Okay, 0.5, which is the 50 level, which is the equilibrium. Then we've got 61.8, which is the sweet spot where we usually like to sell. Then we've got the 100. Most of these levels, I think, with the book, they are not there. So here I'll just leave the 100. Okay, let's see how it's going to look. So it's 1. Let me just confirm. Okay, I'm hoping I got it correct because like an indicator which I don't use, it's kind of hard to set up. Let's see. We need to change the color to black. Okay, it'll be looking something like this. Okay, I hope I didn't get it wrong. Let me see. So I'm going to delete it here, then I'm going to place it, let's say, this high to this low. Okay, that's perfect. So I'll explain how it works just now. So the main levels we have on the Fibonacci, we've got this 100 level, which is right here. We've got the 61.8. This is usually called the sweet spot. Usually when a pattern forms around the 61.8 level, it means there's a high probability of it playing out. So we look for a price action there. Then we've got the 50 level. or the equilibrium or halfway. So most setups, sometimes they usually also like to play around the equilibrium. Then sometimes price, when it retraces, it doesn't reach the 50 or it doesn't reach the 61.8. It reacts on the 38.2. Then it pushes down if it's a downtrend. So these are the main levels, basically, which you need to use. Others, you've got other levels in here. It all depends. And this 100 level, you use it for your stop loss. Okay. So I'm going to try to briefly explain how it works. So let's say trying to look for somewhere where there is a trend. Okay. So the first thing you need to do is you need to know where your trend is going. So for example, okay, I'm using a smaller screen today, so I'm trying to move these things around. Okay, you need a trend. Okay, so we have a peak, price creates a lower low, a lower high, lower low, lower high, lower low. So let's say price is moved from this peak at the top here, and it's broken a structure here, broken a structure here, and created a lower low here. And you want to know where exactly it's going to retrace to. That's where the Fibonacci retracement tool comes in. So you click your fib, you click from the highest high at the top here to the lowest week, right? Okay. So when price starts to retrace now, okay, let me do this. When price starts to retrace, what happens is you wait for it to reach any of the main levels, either the 38.2, 50.0, or 61.8. Okay, so, okay, struggling to grab it. Okay, let me just place it again. So you want to place your fib from the top to the bottom. If you're in a downtrend, always place it from the top right to the bottom. Once you place it like that, I'm not trying to keep these levels close. Okay, something like that. So when your price approaches the first level, which is the 38, you look for price action, you look for candles, you look for everything which we've read so far. You look for those things. So you look for your support and resistance. The last level was here. There is also the last candle, which is our supply zone, which is there, and it's right on 61.8. If you take a closer look, right, that zone there is right on the 61.8. So as price approaches 38.2 right here, you start looking for anything which price left here, which is a clue to show you that they will respect that something which you have, or the confluence which you have for sales. Okay, if there's nothing, you wait until price gives you something. So if you're day trading, obviously you want to wait for the Asian session to pass, and you want to take your trade at the beginning of London session. So you had a nice pin bar, right? At the beginning of London session, between the 50, actually on the 50 level, which is the equilibrium. Okay, so it's also on the 50 EMA. These are all confluences now. So you get your fib price on the 50. You get your 50 price on the 50.0, which is the equilibrium. You get your price reacting off the 50 EMA. You get your price reacting at London Open. These are all confluences. Then you want to check your indicator, which is the TDI, and you see it's bouncing off the 50 static. Then you execute your trade. You enter, stop loss above the pin bar, and the trade plays out. As you can see, it just drops. So same thing, as long as you see that you're in a trend, as long as you see your price creating higher highs, lower highs and lower lows, you know you're in a downtrend. So for the next leg, same thing, from the top to the bottom, you want to measure out where price can potentially reverse it. So price hits this low, so you measure from this high to this low. You want to measure the retracement, right? That's why we use the Fibonacci. It's just to measure your retracement. So as price starts to pull back up again, you can see they come and react right off the 32 zone, right on the 200 EMA, at the just as London session opens. TDI is still trading below the 50 static. That's a downtrend. You take your sell, stop loss above the high of that day, and price drops. So as long as you're in a downtrend, you only need the highest point and the lowest point for you to be able to draw a fib. So I hope that's clear. When we go back to the book, it will be a bit more clear. So I'll look for another example where the price is going up. Okay, this part here where we've got this uptrend. So the other thing is, if you're in an uptrend like this, okay, sometimes you might want to measure from here to here. So remember, you want to take the point which breaks a zone, right? So this is where price took off from before they broke the zone. So that's the valid point we want to use to measure this particular retracement, right? Then same thing will apply for this particular move going up. It started here, then it went to break this one. So let's see if we can apply our fib there. So you come, you hit your fib. Now you are measuring in an uptrend. So you start from the bottom going up. So for the first move, this very first move, when you get a retracement there, okay, let me show you from this area, which breaks this and breaks this candle starts retracing, right? You can put your fib there. So you want to measure where the retracement can get to. So 38.2, 50.0, 61.8. So price reacts around the 50.0. This is the beginning of New York session now. You've got a pin bar, execute your trade. Right? As long as it gives you 1:2 or more in terms of risk to reward ratio, you can execute the trade. All right, so that was a valid use of the fib. If you find it confusing, don't use it. You don't necessarily have to use the fib also, because personally I don't use it because sometimes it confuses. But if you understand how to use it, or if you want us to do more lessons on the fib, maybe you could just let us know in the comment section. Then we'll try to do more videos specifically for the Fibonacci indicator or for the Fibonacci 2. So for this particular move now, okay, let's say you measured this to here and you took this as the retracement. You see price comes and reacts around the 200 EMA, around the 61.8. You can take this trade, but the only reason I wouldn't like to take it is because it happens right at midnight. If you are day trading, you don't want to hold your trades like overnight. But if you can wait until the next day, you can open your trades even here. Have your stop loss just below this last low, or you can prefer trading in London because price is still in that safe zone where you can actually buy from and make a profit. Okay, so basically that's how you use the fib. So I hope this is clear. Without wasting much time, let's actually go back to the book. So let me just do this. Okay, there we go. We were on page 99, page 100. Okay, so I hope everything is making sense. If it's not making sense, or if maybe there's a part which is not a bit clearer, you can just state it on the comments. Then I'll try to make a video on it specifically so that it becomes a bit more understandable. All right, so we're going to continue with our reading, the Candlestick Trading Bible being decoded. Okay, pin bar trade examples. So I think we're talking about pin bars from the last time. So we're going to start from here. I'll give you some trading examples to help you understand how to trade the pin bar candlestick pattern with the trend and how to use the confluence concept to confirm your entries. So while we're here, remember, you need confluence. Before you take any trade, you need confluence. Confluence simply means you need reasons to execute your trade. You cannot just execute your trade because of one reason, or maybe because you've seen a pin bar only and you want to execute. You must not do that. You need 2, 3, 4 things lining up together. The more the confluence is, the higher the probability of the trade actually playing out. So always make sure you wait for the confluence to line up. You need at least 3 reasons for you to execute a trade. And also Fibonacci retracement too is always good to use on higher time frames, like your H4 daily. Sometimes you can use it on the H1, but it's always best if you can try to use it on the higher time frames for better results. Okay, so the chart below, NZD-USD daily, downtrend markets, 21 moving average, pin bar sell signal. Okay, so price is in a downtrend. Okay, price is pushing down, as you can see. Okay, there is no previous data here, so we just assume it's in a downtrend, right? Because a structure has been broken right there. Once a structure has been broken, you want to see price starts to reverse. So it means now you've got point A and point B. So as the price retraces, you can bring in your Fibonacci 2 from the highest point to the lowest point, which is this point here. Then once you plot it, you want to wait for price to reach 50 level or 68. These are the best spots. For this particular book, you can see the author put 61.8 and 50.0. There is no 38.2 or any other numbers. It's just these main ones. This is your main sweet spot where you look for your entries. All right, so price retraces, they hit, they give a pin bar. That's the first confluence, a pin bar, right? I'm just going to put PB here. The second confluence is the moving average. That's where price is given the pin bar. The third confluence is price hitting the 50.0 level on the Fibonacci, right? And at the same time, this level, remember, it's been broken. It's now what? It's now your resistance level. So these are four confluences lining up for you to take the trade. So as soon as you see the pin bar close, enter your trade, stop loss above the pin bar, then it should actually play out and break the zone most of the times. But you can always take profit along the way, right? Because sometimes price can hit equal lows and push up. So I hope that's clear. I'll try to slide to the charts to show an example again just now. Okay, so this is NZD USD daily chart. As you can see, the market is trending down. This is the first information we gather from this chart. After the breakout of the support level, that becomes resistance. The price retraces back to this level and formed a pin bar candlestick pattern. The formation of the pin bar near the resistance level indicates that the retracement move is over and the beginning of an impulsive move is likely to happen. So when we're trading again, the main thing is we want to catch the impulsive moves. The impulsive moves are the bigger moves. Like when your price is moving in a downtrend, for example, these moves going down, these are your impulsive moves. Price retraces gives you an impulsive. So you want to catch the bigger parts of the moves as the price is going down. When we put the 21 moving average and the Fibonacci retracement on the chart, we see that the pin bar is rejected from these levels, which indicates that this level is very important and sellers are willing to push the market lower. Here in this example, we have solid reasons to sell the market. The first reason is the downtrend, right? Remember the confluences here, they are being listed now as reasons. Second reason is the formation of the pin bar near the resistance level, which indicates the end of the pullback and the beginning of a new move downward. The third reason is the rejection of the pin bar from the resistance level from the 21 moving average. The last reason is the pin bar rejection from the 50% Fibonacci retracement level, which is considered to be one of the most powerful key levels. Okay, 50% fib retracement level is considered to be one of the most powerful key levels in the market. Look at the chart below to see what happened next. So remember our chart, how price was looking like, right? We had all our confluences lining up. We executed the trade. Price is moving. And what you see here is this is a swing trade because this is on the daily. You can look for the same move on a 4-hour chart, right? You can look for the same move on a 1-hour chart, 2-hour chart, whatever type of trader you are, is just the same concept. Okay. So you enter, stop loss, then price just dropped. First they hit this zone, they broke it, then they continue to push down. Okay, so that's actually a good risk to reward ratio, which you actually obtain by catching the impulsive move. As you can see in the chart above, our analysis was right because it was based on solid reasons to enter the market. This is the method that I want you to learn to be able to trade the market successfully. Look at another chart below. So on the chart below, you can already see, remember from what we explained, the basics. You want to look at your chart and figure out, is the market trending? Is it going up? Is it coming down? or is it sideways, or is it choppy, right? So when you open your chart, you check, okay, my price is creating what? Higher highs, higher lows, higher highs, higher lows. So it's an uptrend. If it's an uptrend, for every impulsive move, you want point A and point B, you measure the retracement, you enter. Price moves, it starts to retrace, you put point A, point B, you put your fib level, you wait for the retracement, and you enter. So for this particular example, you can see the price was coming from this peak formation low on the bottom. We break a structure here, which is visible, right? We break it, we come back right on that support level. We throw what? A pin bar, first thing. Second thing, we are on the support, we throw a pin bar, there's a moving average, and if we line up a fib, okay, remember a valid fib, you want the part where price is taking off and breaking a structure. So for this particular example, the author used this zone and this zone, mainly because this was the main zone holding the price from the top side, right? So it's the zone which was broken, and he just took it from this, but sometimes you can measure it from here. There's nothing wrong with measuring from here. So price will just push, instead of hitting the 50, probably it would have reacted on the 61.8 on that particular example. So there's no right way, like you should strictly do this. You know, there's variations to everything. As long as the setup and the confluences line up, everything is correct. So the fib was lined up here. Price broke a structure. We've got point A, we've got point B. As it starts to retrace, that's when you put your fib, right? As price is pushing down, it's pushing down, you are waiting, you're out of the charts. It gets here, it throws you a pin bar right on the 50. As the pin bar closes, you see it's rejected. The support level is rejected, the 50 level is rejected, the moving average. Those are all reasons to enter. And if you've got an indicator on the bottom here, if it shows you something as well, you can just add the confluences and execute, right? Price pushed up, broke this level, started to retrace. Again, you've got point A, point B. You are in an uptrend because a high level has been broken, okay? Price retraces, you wait. They start throwing you pin bars here, right? You're waiting for confirmation. Sometimes, let's say you enter a trade, you feel like this is your pin bar, right? It's reacted off the 50, off the support zone. There's nothing wrong with this. You enter your buy, stop loss goes just below the pin bar. So if the price comes and takes it out with another pin bar, right? On the 61.8 level, again on the same zone, it's just basically the same sweet spot zone where you're looking for buys. So you can still re-enter the trade and recover your loss and end up in net profit, because you can see the move which happened after that was actually quite huge. All right, so I hope that's clear. The chart above shows two important buying opportunities. The market was trending up. The formation of the first pin bar after the retracement back to the support level was a high probability entry. What confirms our entry is the rejection of from the 21 moving average and the 50% fib level, fib retracement. Okay, whilst we're here, remember, for us, specifically us, we use the 13 EMA, we use the 50, we use the 200 and the 800. These are all exponential moving averages, and they're all set to close. The author uses the 21 moving average. So remember, as long as you understand the concept of moving averages, they basically work the same. Okay, so don't get too confused, because when I go to my charts, you see these moving averages. When we're in the book, you see these moving averages. So don't get too confused. They just work basically the same. Okay, the same thing happens with the second pin bar that allowed us to enter the market again and make more profits. Trading pin bars in range-bound markets. Okay, so we are coming now from what? From a trending market into a ranging market, right? So we can say that a market is in a range, is ranging when prices don't make any higher high and higher low, and start trading horizontally between definable level of support and a definable level of resistance. Once I see that the market changes its behavior, I have to change my tactics and adopt a trading strategy that fits this new market condition. To confirm a ranging market, I have to look for at least 2 touches of the support level and 2 touches of the resistance level. And once I have identified the range, then it becomes very simple to trade it by going long when prices reaches the support level and going short when price reaches the resistance level. See below an example of a range bound market. So I'm sure we've been talking about this before. Once price hits a level 2 times, top side 2 times, bottom side, and it doesn't break, you know you are in a range market. You don't trade in between. That's the first thing. You only look for sells at this top until they break, and you only look for buys at this bottom until they break. That's it. All right, so I hope that's clear as well. As you see, as price approaches the key support and resistance level, we have an opportunity to buy or sell the market. We need to just wait for a clear price action setup as a pin bar, such as a pin bar candlestick. Look at the illustration below. Okay, so I just want to highlight this. We need to just wait for clear price action. All right. Okay, so you can see the example below here. This is the daily chart. Again, the higher the time frame, the stronger the confluence, the stronger the weight of the setup. Okay, so this is the daily chart. You can see we've got 2 clear hits to the top, 2 clear hits to the bottom. You can even count this one and this one. That's still fine. Okay. Support level, buy zone, pin bar signal, pin bar signal. So you can see the pin bar candles here. The signal buys while it's you're on the support zone. And the opposite is true. If you see a pin bar on the top side, then you can basically take your sell from the top side if you see a pin bar there. Okay, let's go down with it. The illustration above shows us 3 trading opportunities. Let me explain to you how you can trade them successfully. The first one is a pin bar rejection from the support level. You can place a buy order after the pin bar closes, or you wait for the market to touch the 50% of the pin bar range. This is as explained. You remember in the very first few chapters, we read how to have safer entries and how to have aggressive entries on the pin bars. This is exactly what they're talking about here. Your stop loss should be placed above the support level, and your profit target must be placed near the resistance level. The risk of this trade is the risk to reward of this trade is very attractive. The second trading opportunity occurs near the support level. You place a buy order after the close of the pin bar, and your stop loss should be below the support level. Your profit target is the next resistance level. The third setup is an obvious buying opportunity. As you can see, the market was rejected from the support level and formed a pin bar to inform us that the buyers are still there, and the market is likely to bounce from the support level. Trading from major key support and resistance level is the easiest ways to make money trading range-bound markets. Don't ever try to trade any setup if it is not strongly rejected from these areas. The second strategy is about waiting. So the second strategy is about trading in the direction of the breakouts of major key levels, or waiting for the prices to retrace back to the breakout point, and then you go long or you go short on the market. See the example below. So remember, if we had a pin bar here, we could have bought, but we didn't have a pin bar and price broke, came back to this support zone, which was broken, and it's now a resistance. They throw a pin bar. That's where you take your sell. Okay, if you want examples, we'll jump into the charts just now. And you can also do the same on your side, depending with what you trade. Okay, look for a ranging market, mark the zones, see how price reacted when it broke out. Did it fake out and come back inside? Did it break out? Okay. So you can see this H4, AUD, and ZD. The figure above illustrates a range-bound market, and the price broke out of the support level and retraced back to the point of the breakout, and the formation of an obvious pin bar indicates a high probability signal to short the market. This is how professional traders trade ranging markets, based on this price action signal. How to confirm pin bar signals using technical indicators. Using technical indicators to confirm your entries will increase your probability of trading, of the trade being profitable. I'm not telling you that you have to focus on indicators to generate signals, because this will never work for you. But if you can combine your price action strategies with the right indicators, you will be able to filter your signals and trade the best setups. Before we actually proceed, you should know that you also can trade without having indicators, but just having your support and resistance lines and knowing your price action, it's still fine. But for the concept or basis of this book, we're just going to explain what's in the book as it is. Okay, but you should know you can also trade without having indicators. You just need to know your price action better, support and resistance, supply and demand. All right, one of the best indicators that I use to confirm my entries when I examine a range-bound market is the Bollinger Bands indicator. This technical trading tool was developed by John Bollinger to measure a market's volatility. The strategy is very simple. We'll combine horizontal support and resistance with the upper and lower Bollinger Bands false breakout if prices are rejected from major key levels and from the bands. This is a confirmation that the market will bounce from these levels. See an example below. So before we look into the chart, I don't think I would advise using this because it makes your chart a bit crowded. So just talking from experience, I wouldn't advise you guys to use these bands. But if you want to, if you feel like they work for you, you can place them on your chart. But I won't show using an example because we do not use them. Okay. But if you want to use them, basically, they are being used as a dynamic support and resistance, just like moving averages, if I may put it that way. So if price comes to the top, you want to look for anything telling you to go short or to sell, right? If price hits the bottom, you want to look for something telling you to buy, something like that. But I wouldn't personally advise you to use this indicator because we do not. If you check even some of our other lessons, we don't use this. It will just make your chart ugly and it might confuse you. So I'll just try to go through this as fast as possible, right? Okay, if you look at the chart above, you notice how the Bollinger Bands act as a dynamic support and resistance when the market approaches the upper or the lower bands. Price bounces strongly. So if we see that a pin bar is rejected from a horizontal key level from the bands, this is a clear confirmation to buy or sell the market. This confirmation strategy is very simple and it will help you decide whether to take a trade or to ignore it. Because trading is all about emotions, and sometimes you spot a nice pin bar signal in a range-bound market, but you'll find it difficult to make a decision. What you have to do in this case is simple. Just put your Bollinger Bands on your chart, and if you see that the signal is rejected from the horizontal levels and from the bands, don't overthink about what you should do next. Just execute your trade, place your stop loss and profit target, then steer away, let the market do the work for you. This basically explains everything. It doesn't just cover Bollinger Bands. Everything you do, whatever confluence you have, if you have a setup, execute your trade first thing, place your stop loss second thing, put your take profit third thing, and always make sure there's proper risk management, right? And always make sure your risk to reward ratio is more than 1:2 at least. Then once you do this, as long as it's proper risk, you can be able to even close your charts, let the trade play out, then check it later. It's harder being done. It's easier being said than done, if I may put it that way. But it's actually the way to be more consistent and profitable. So if you come back and your trade is a loss, you just journal it, write your notes on why the trade didn't play out. If it plays out, again, journal it, write your notes why the trade played out, and try to take note of the pattern because patterns repeat themselves. Right. Okay, you can see the example there. You can see this is the pin bar on the top of the Bollinger Bands, so the price sold. There's a pin bar there, price sold. At the bottom there, pin bar, price bought. continuation, right? So I won't look or talk much about it. I'll just pinpoint it. So let me see if the engulfing. Let me see. Okay. All right. So I just want to skip this part, or let me just go through it since it's just one page. The daily chart above shows us how this indicator could help us execute our daily trades. Okay, sorry about that. The daily chart above shows us how this indicator could help us execute our trades with confidence. The false breakout of the resistance level that was made by the pin bar was a powerful signal to short the market. The trade was confirmed by the false breakout of the upper band as well. Remember that this technical indicator is used just as a confirmation tool in a range-bound markets. Don't use it to generate signals. Use it always in combination with horizontal key levels, and you will see how this strategy will affect positively your trading account. In conclusion, I recommend you to practice these strategies as much as you can before you open and fund your trading account. Again, practice makes perfect. You need to put as much screen time as you can. So we're going to now to talk about the engulfing bar candlestick pattern. The engulfing bar pattern is one of the most powerful and profitable price action patterns. Knowing how to use it properly as an entry signal will tremendously improve your trading profitability. In this section, you will learn how to use the engulfing bar pattern profitably. It doesn't matter if you're a beginner or an advanced trader. If you are looking for seriously a better trading strategy more than what you've been using, you have come to the right place. What is an engulfing bar pattern? This reversal candlestick pattern consists of two opposite colored bodies in which the second body engulfs or covers the first body. Okay, you can see this is an example. If it's going up, it's called a bullish engulfing candle. If it's coming down, it's called a bearish engulfing candle. Okay. A bullish engulfing pattern forms at the end of a downtrend, and it provides a clear signal that the buying pressure is overwhelmed the selling pressure. In other words, the buyers are now involved. A bearish engulfing pattern occurs at the end of an uptrend. It is a top trend reversal indicator. It shows that the bulls are no more in control of the market and the price is likely to reverse. See the illustration below. So on the chart, you can see price was coming down. Then we get one big bullish candle here at the bottom, covering the red one, right? And the price reverses. It faces the other way. Let's see what they say below that. Bearish engulfing bar. So that's the bearish one. Almost looks like a pin bar, right there. Then price comes to almost challenge it, then it drops. Okay, so there's different variations to everything. Okay. According to Steve Nissen, the father of modern candlestick charting, this candlestick must meet three important criteria to be considered as a reversal pattern. Okay. This candlestick must meet three important criteria to be considered as a reversal pattern. The market is in a clearly definable uptrend or downtrend. The engulfing candle comprises of two candlesticks. The first body is entirely engulfed by the second one. The second real body is the opposite of the first real body. So those are the rules. Okay, how to trade the engulfing bar price action signals. Okay, before we proceed, we just want to quickly slide to the chart. Let's look for an example. Let's zoom in. Okay, we're not going far. This is today's price action. I'm going to remove this fib. I hope it's clear. I'm going to zoom in again. Okay, so first thing, we are in a clear uptrend, right? Second thing, we have two candles, one small one, one big one, and the big one engulfs the small one, and it's a clear uptrend. Right, that's a bearish engulfing. So depending with the confluences we have, we can take this trade from here when the candlestick closes stop loss above the bullish engulfing. Then as you can see, price drops. It all depends with how you view it, because remember these variations. Somebody might have taken this as a bearish engulfing because we're in an uptrend, right? This is also small, but remember some trades will play out, some won't. Sometimes the dealer will come and take liquidity, which is a term which we'll explain in other lessons. Then they will drop. So it's all about variations. Let's see. We want to look for a bullish engulfing. Okay, I'm looking for a downtrend. Definable downtrend. Okay, perfect. You can see we're in a downtrend here. Price is coming down. Lower low, lower high. When it creates this lower low here, the second candle covers the first one. It's not really the perfect one, but you can see the body of this candle has been covered by the second one. All the criteria have been met, right? With liquidity having been taken here, sell side liquidity, right? Then the price reverses and starts to push up. That's just an example. So you want to look for these particular candles on your high time frames mainly, but you can also look for it on the H1. Nothing wrong with that. Okay, let's see if we can pinpoint one quickly here. Can consider this one, though the price was already in a downtrend, but intraday would still have been valid, but not the best of examples. Okay, let's see, can we pick one more? Okay, this one here, we are in a strong downtrend, right? There we go. As long as the body is bigger than the previous one, it should count as a bullish engulfing. So I hope the visuals of the candlestick, the bullish and bearish engulfing candlesticks are clear there. Okay, let me just check which page we own, 111. Let's see if we can push 5 more pages. So how to trade the engulfing bar price action signals. To trade profitably this chart candlestick pattern, you need to respect 3 important elements. The trend. Okay. If you look at any chart, you will notice that there are times where the market is moving clearly in one direction and times where it is moving sideways. To be honest, trading the engulfing bar pattern with the trend is the easiest way to make money in the market. You don't need to be highly knowledgeable about technical analysis to determine whether the market is trending or not. Make it stupid simple. If the market is making a series of higher highs and higher lows, it is about an uptrend market. And if it is making a series of lower highs and lower lows, it's simply about a downtrend market. You can see this is an example. We've been talking about this on most of the sessions. What's a clear uptrend? The illustration above shows a clear uptrend. You don't need to use an indicator to determine whether the market is trending or not. Just look at your chart and try to apply the concept of higher highs and higher lows and vice versa. When you're analyzing your charts, be in mind that the markets move in trends, and trading with the trend is the most important element in your technical analysis. There is no more important than the trend, right? Don't ever try to fight it or control it. Otherwise, you pay expensively for trying. You can't make money under any market conditions, no matter how powerful is your trading system. You have to be patient enough to let the market tell you which direction it's going to take. Successful traders say the trend is your friend, and if you want to master trading the engulfing bar pattern, your first rule is to follow the market direction. In other words, the trend should be your best friend. Then the second thing is the level. When you find a clearly definable uptrend or downtrend, The next step is to identify the most important levels in the market. I mean the most powerful support and resistance. If the price tests a support level and stop, this is an indication that the buyers are there. This area is watched by all participants in the markets because it represents a great buying opportunity. Conversely, if price tests a resistance level and stop in an uptrend, this is a clear signal that selling strength is in the market. The example below shows how the market participants interact with support and resistance levels. Okay, so you can see the market was moving in a downtrend there. At some point, it was ranging. You can see they dropped, they ranged, they dropped, they ranged. So you just need to pay attention at what the price will be doing, right? These levels take different forms, such as trend lines, channels, flags, triangles, and your ability to identify them in your chart will help you to find better price levels in the market. So I believe this is also a lesson on its own. Trend lines, channels, flags, triangles, you know, these are all shapes or patterns which the price does when it moves. In trending markets, when price passes through resistance level, that resistance could become support. See the illustration below to understand how to trade engulfing bar pattern with support and resistance in a bullish or bearish trend. Okay, you can see price was pushing up here. They hit a level, then they broke it, retested it, bullish engulfing, the price continued. Okay, so most of the times it's always good to wait for a retest, especially when price breaks a zone. Those setups usually pay better from my understanding or from my trading. These setups pay better when price actually comes to retest, because sometimes if you chase price, you enter a buy here, it will drag you back down. So always wait for the price to come back and retest. I'm not sure how much long I have in this session. Once you see it freezing, it kind of shows I'll be running out of time, but let me try to round up quickly. There are other technical tools that can help us find the best levels in the market, such as supply and demand areas, moving averages, and Fibonacci retracement ratios. Then the third aspect is the signal. The signal here is an engulfing bar pattern. You can apply the same rules when trading the inside bar candlestick pattern. Your ability to identify an engulfing candlestick at a key level in a clear uptrend or downtrend will greatly enhance the probabilities of making a winning trade. See another example below. Okay, you can see price breaks a zone, pulls back, throws a pin bar initially. So you could have taken a buy there, stop loss just below. Price pulled down, gave a bullish engulfing, so you can take another buy there or wait for half retracement of that particular move. So you can also use your fib to measure from here to the top of the candle. You want to measure halfway so that you enter and you have your stop loss just below. Okay. Another level is broken here, but nothing really comes back to test. Okay, this looks like a bullish engulfing here, though they didn't mark it, but it would qualify. Okay, trading the engulfing bar with moving averages. Okay, before we go to the moving averages, let's see. Okay, let me just go through, then we round up with the actual chart. Trading the engulfing bar pattern with moving averages provide a very profitable trading strategy. However, the lack of knowledge about using the moving average can damage dramatically your trading account. So I always see many people with moving averages on their charts. If you ask them how they use those moving averages, they don't know. They just copy people because they see a certain trader with maybe the 50 and the 200. They put those. They see a certain book with the 21 and the 50, they put those. They see somebody with the 8 and the 20, they put those, but they don't know how moving averages work. So if you feel like we should do a lesson explaining moving averages, comment in the comment section. Then we'll do a session specifically for moving averages and how they work. Basically, they work the same way, but you need to understand how to use them. All right. Traders use moving averages in different ways as a trend following tool to identify the direction of the trend. So they buy the market when prices are above the 200 simple moving average, and they sell the market when the price is below the 200 simple moving average. To determine whether the market is overbought or oversold, we just watch how price interacts with the moving averages. For example, in an uptrend, if price is moving far from the moving averages, this is an indication that the market is overbought. To predict the trend change by using the crossover strategy, if the moving average crosses over the other, it's a signal of a trend reversal. As any trading system, the moving averages have disadvantages. This is why you have to know how to use it successfully under the right market conditions. This trading technical tool doesn't apply to all markets. Don't never try to use it in range-bound markets, right? Moving averages are not used in a ranging market because you get a lot of false signals and you will definitely blow up your trading account. To the best of my knowledge, using moving averages is a dynamic support and resistance in trading markets. In combination with an engulfing bar pattern signal is the perfect way to make money in the market. This strategy is very simple. We'll use the 21 and the 8 simple moving averages in the daily and the 4-hour time frames. We'll define a clear bullish or bearish market, and we simply buy when the price pulls back to the moving average and an engulfing bar pattern forms. So before we even look at their chart, let's look at our chart and look for that example if it's true. So the first thing we want to look for is a higher time frame chart. All right, we're going to plug in on H4 GBP USD. I'm going to zoom in a little bit. That won't be clear. Let's see. Okay, something like this. I hope this is clear for you guys. So once you determine that your price is pushing up, the only thing you do is you wait for the price to come near the moving average. Then you look for your candle. You look for your bullish engulfing, or you look for your pin bar. So I'm going to start this from the bottom here so that it's clear. Okay, so you see we are pushing up, right? We all agree price is pushing up, right? We are above the moving averages. We are in an uptrend. Price retraces. They throw a huge bullish engulfing candle. We are in the trade. We are active. We are in a bullish. We are in a bullish move or in an uptrend, right? Price moves again. They throw another one there. That's a bullish engulfing if you actually zoom in, right? The market goes sideways a little bit. Then they break out from here, bullish engulfing, right? Price keeps moving. Okay, this is yesterday. Reacting off the 50 level, 3 hits, bullish engulfing. Take a buy, New York session. You can see the price moved. Another one there into the close of the day. This one, I wouldn't like to take it again. Like I said, we don't trade during these hours, like at midnight. And this was like the week crossover. So there's a weekend in between. You see, this is like 4 hours. So there's a weekend there. We don't hold trades over the weekend. But you can see the examples there. You can open your charts, whatever you trade, look for those particular examples. Let's see on a downtrend. Can we get a downtrend? Okay. This part here. Huge bearish engulfing. We're in a downtrend. It's a moving average. We sell. This one is not clear. It's another type of candlestick, though it's a valid setup for a sell. Okay, anything else here? What else do we see? We've got one there. We could have taken this, but it would have been stopped out. Okay, so sometimes if the moving average is, again, depending with what you use, you need to understand if the price is far away from the moving averages, it will retrace a bit. Okay, so we only want to sell when it's closer to the main moving average. So I hope that helps, and you can just quickly go to whatever you trade and check for yourself if whatever we're reading is actually true. And then you can comment your inputs in the comment section. Okay, see the illustration below. You can see the example there. We are in an uptrend. Price breaks zone. Right, there's the 8, there's the 21. As we use the 13 and the 50. Okay, price pushes, comes back, bearish engulfing, pushes, comes back. This one is not a sorry, bullish engulfing. Pushes back here, that's invalid, but this was the best bullish engulfing candle there, so we could have taken that trade there. Stop loss goes below here, then as price is moving, you just trail your stop loss and just keep following price until it takes you out, right? Especially if you're in a trading market. Conversely, if the moving average is trending down, it shows that the market is in a downtrend, and we sell when the price retraces to the moving average. The screenshot below shows how prices interact with the moving averages as a dynamic resistance level, and how the engulfing bar pattern represented a high probability setup. So you can see here we're in a downtrend. Price is creating what? Lower highs, lower lows, lower lows, lower highs, lower lows. You're in a downtrend. As price is moving, you just wait for it to retrace to the moving average. Then you look for the pin bar, or you look for a bearish engulfing if you're selling, right? So we're trading continuation of price trend, right? We're not using it as a reversal now, we're using it as a continuation, right? There's another one there. Price retraces, gives you a nice candle, you take the trade. Okay, so I hope that's clear. How to trade engulfing bar with fibs. Okay, let's continue from page 120. Okay, so for today, let's just go and dissect what we learned, especially the fib, how to use the Fibonacci in a trending market. Practice that. If you've got questions, you can just write on the comment section. Let's have a conversation. If you've got something to add, something to subtract, you can just comment on the comment section. Then we will resume from how to trade the engulfing bar with the fib. So we're going to resume from page 120. Thank you so much for making time to join. If you've been watching the other videos, thank you so much for your support. If you find the content helpful, you can just share with a friend, or you can just comment your inputs, and we can grow from there. We just share information. We all make money. Excuse me. So I hope this video helps like the other ones, and I hope if you're not profitable, I hope you become profitable after reading this. Practice makes perfect. If you still need help, you can just WhatsApp us or hit us up on Telegram or on the comment section. We'll still be able to communicate and share more information. And if there's anything else, or maybe another book you want us to go through when we finish this one, do let us know in the comment section and we'll get onto it. So thank you so much, guys, for your time. Enjoy your trading.